Properly understanding these things about risk could potentially change your investing game to the tunes of millions of dollars over the course of your career. So risk is a concept in finance that talks about how much money is at stake over a certain period of time. And the reason most people misunderstand it is because most people just focus on the amount of money that could be lost and don't really pay attention to the time period in which it could be lost. In reality, both variables are equally as important to assessing risk, not so much just one or the other. I would argue that the average trader or investor is typically overexposed on a long-term basis and actually underexposed on a daily basis. Now, what do I mean by that? So when somebody's overexposed, typically it means that the amount of money that they stand to lose over a certain period of time is far too great relative to the amount they're comfortable with losing. Another way to think about it is that if they lose that amount of money in that certain period of time, they will be unable to accomplish their financial goals. So let's take these extreme examples. Let's say you have $1 million in a portfolio, and you could stand to lose up to $100,000 over the span of 30 years. Now, if you really break that down year by year, that's not much risk at all. In fact, on a yearly basis, your exposure divided out is just 0.33% a year. Most people are actually quite comfortable with that level of risk. Now let's take the flip side of that example. You still have $1 million, but you stand to lose the same $100,000, except this time it's just in a period of 1 week. That's significantly different. Even though the dollar amount that you're exposed to is the same, the time period makes all the difference. Most people could not handle a 10% drawdown in their portfolio in just a single week. So when you talk about over and underexposed, you're not just talking about the dollar amount. The time period is equally as important. Now, most people can wrap their heads around why being overexposed is a bad idea. Obviously, if you lose that money, you're not going to be able to sleep well at night, and you possibly could lose the opportunity to accomplish some of the goals that you had in mind with that money. Why doesn't the financial world talk more about the dangers of being underexposed? I think the biggest reason, and this is just my personal opinion, it boils down to the fact that people are more scared to lose a certain amount of money than they are excited to make that same amount of money. For example, let's say in an investment you could potentially make $100,000 or lose $100,000. Most people would feel a lot more pain and fear about losing the $100,000 than they would feel excitement and joy over making the $100,000. This is why risk always ties back to trader psychology. However, just because the financial world doesn't typically talk about the dangers of being underexposed, the reality is if somebody is underexposed, what it means is over time, they're leaving a lot of money on the table, which in a sense leads to the same danger as being overexposed does. Why is that? If somebody's overexposed, they risk not being able to live the life that they want to live with the financial goals that they have in mind. Well, when you're overexposed, it's easy to understand why that is. But when you're underexposed, that same danger still exists. That same danger comes in the form of not being able to make enough money to live the life that you want to live, because you're not exactly sure how to take it. So why am I talking about all of this? Well, the reason I'm talking about this is because typically when people have investments in the stock market, they are exposed to everything that the market does. And unfortunately, the market is what we call asymmetrical. What does that mean? In periods like 2008 or 2020, where you had the great financial crisis and then COVID, respectively, what you tend to have are huge outlier drawdowns to the tune of 20, 30, 40, even 50% in just a span of a couple months. Most people are not comfortable with taking that kind of risk. On the flip side, the vast majority of the time in the stock market, you tend to grind higher, maybe 0.2, 0.3% a day. And that kind of risk is actually very manageable for most people. In fact, if I ask people, what would you be comfortable if you had a really bad day? What would you be comfortable with losing? It's not 20%, but it's also not 0.2 or 0.3%. It's usually somewhere in between. So the reason this is such an important concept to understand isn't because people necessarily don't have the right investments. So because most people are comfortable with risking maybe 1, 2, or 3% a day, but they're not comfortable with seeing their portfolio draw down by 40 or 50% in a given month, there are certain strategies that you can employ to mitigate that portfolio exposure in a catastrophe situation while still amplifying your risk and being able to make more money on the day-to-day. Remember the typical financial relationship between risk and return. When you take more risk, you tend to make more money over time. You take less risk, you tend to make less money over time. Well, the thing is what if there was a way you can reduce that huge outlier exposure that could happen in a financial catastrophe, but still elevate your risk on the days where the market doesn't really do much? Because after all, if you're willing to risk 1, 2 to 3% a day, most times the stock market doesn't move near that 90-95% of the time. We use those tools at AK Investing in order to make the risk profile of the portfolio as close as possible to what the client actually wants. And the way we do that is by taking away some of that outlier exposure that could happen in a financial catastrophe, and instead we amplify the risk that we tend to see on a daily basis. That way, if you're willing to risk a little bit more on a day-to-day basis, you can make a little bit more on a day-to-day basis. And remember, if 90% of the time you just take a little bit more risk, then those additional returns should compound themselves into a much more sizable investment account over the span of 10, 20, or 30 years. In the meanwhile, you save yourself from that nasty drawdown situation that could occur in a financial crisis, like we saw in 2008 or 2020, and you focus on the day-to-day as opposed to worrying about what can happen in a one-off instance. By using these tools, we can essentially take that risk that exists in those one-off instances and transfer it into the day-to-day life of the portfolio. So essentially, you're still taking a healthy amount of risk, but you're taking it in a way that prevents your portfolio from taking huge drawdowns in a short period of time, and instead allows your portfolio to have a little bit more fluctuation on normal days, but those additional fluctuations allow your portfolio to potentially make more money. And over the span of 10, 20, 30 years, those incremental additional returns that come from taking a little bit more risk can add up to a substantial amount of money over time. So essentially, by taking on a little bit more risk over the 90% of days where not much happens in the market, you can substantially increase your portfolio's expected return, and over time that will account for something meaningful. So some takeaways from today. Number 1, risk is not just the amount of money that you could stand to lose, but it also takes into account the time period in which you could lose it. Number 2, being overexposed in your portfolio is just as bad as being underexposed, but most people don't talk about it because of the fear that comes around losing money. Number 3, the market is asymmetrical, which means 90 to 95% of the time you're going to see moves in the market that wouldn't make anybody lose any sleep. But those 5% of instances could really rock the boats for a lot of investors that aren't really comfortable with a lot of risk. So by using tools at your disposal like options, alternative asset classes, and alternative investments, you could make your portfolio's risk profile more in line with what you actually want, as opposed to just being at the whims of the market. Hey, thanks so much for watching this episode. If you want to get more content from us, just like, subscribe to this channel. You'll get notifications from us as we post new content. Hopefully this makes you a better trader and investor. That's our goal here at AK Investing. Thank you so much for tuning in, and we'll see you next time. Bye-bye.